Do you know what your company's profit and loss is telling you? I do, and I'll share some quick tips on how to read them and understand some of the basics of this important financial statement.
Welcome to this episode of Accounting and Tax Tips, Smart Strategies for Small Business Success, with certified public accountant Tina Moe.
As a business owner, it becomes increasingly important to understand your financial statements, what they mean, and how to use the information they provide. It's important because they reflect performance of your business and help you make informed decisions such as, can you afford to hire help? Can you afford to move the business to a bigger location? Did your business grow over the previous year? And financial statements are definitely key for adequate tax planning. My series on financial statement basic begins with the look at the profit and loss statement, which by the way is synonymous with the terms income statement. Other terms used to describe the profit and loss include P&L, earnings statement, revenue statement, operating statement, statement of operations, and statement of financial performance. All of these terms are referring to the profit and loss statement. Some profit and loss statements are very complex, and some are very simple. It just depends on the type of business, the size of the business, and the complexity of its transactions. Today I'm referring to the simplest form of this financial statement to give you a very basic understanding of it. The profit and loss statement is the measurement of the performance of your business over a certain accounting period. This can be a month, a quarter, or an entire year, and it reflects the income your business earned less the expenses it incurred and the difference between the two resulting in either a net operating profit or a net operating loss. The profit and loss statement follows a general format for generally accepted accounting principles. It begins with the income, also referred to as revenue or sales, followed by the cost of goods sold section. Cost of goods sold should consist of direct expenses related to the revenue. For example, if I own a construction company, my materials and labor would be considered my cost of sales. Both of these expenses are directly related to the earnings process, so as a business owner, I would want to segregate those expenses from other indirect expenses so I can measure how much of my revenue is going towards these direct costs. Then the difference between your income and your cost of sales is called gross profit. The next section, following the cost of sales, will list all of your other expenses or indirect expenses, such as telephone, insurance, office rent, advertising, depreciation, interest, etc. We call these indirect expenses because you really can't directly relate them to the earnings process. They are simply the costs associated with doing business. The total of these indirect expenses are then subtracted from your gross profit to arrive at your net operating income or loss. This resulting number is what we begin to look at for tax planning purposes and the number you should look at to determine if your business is profitable or losing money. And one more quick note. When you buy larger ticket items such as business vehicles, equipment, or buildings, these are not reported on the profit and loss, but rather on the balance sheet where they are depreciated over time. So it's just the depreciation for the accounting period that is reported on the profit and loss statement. Be sure to check out my next show, which will cover the basics of the balance sheet. For more information, visit my website at www.actservices-inc.com.
Thank you for watching this episode of Accounting and Tax Tips with Tina Moe. For more great information, visit Tina's website at www.actservices-inc.com. Also browse the other shows found right here at Indie Biz TV Shows.